The MACD is one of the most overused and least understood indicators on the market. Every newcomer has come across the MACD very early on in trading. You're taught to sell when it's overbought and to buy when it's oversold. If you spend 5 minutes looking at any chart, you'll come to the conclusion that it's a load of bullshit. The reason is because the MACD is a visual tool that determines, or at least shows you, the strength, direction, momentum, and duration of a move. That's all it is. It is not an indicator on when to buy and when to sell. The MACD crossover doesn't mean a f***ing thing. So how I use the MACD is to look at positive and negative divergences. And how this works is when you find a trend of a stock, and I prefer using the 1 hour or the daily chart for this, is you find a trend and you see when it generates a new low, and you see on the MACD that it actually diverges because it goes in the opposite direction. It starts going upwards when the stock price goes down. So a higher low is created when a lower low is made on the chart. This is where the divergence comes in. It signals that there is less strength in the selling every time it makes a new low. Therefore, the MACD rises. You can sort of see it visually, but it's not quite clear in the volume bars, so the MACD is a real good visual indicator to show you this. It shows that the price movement is weak. Now, this tool doesn't determine when you should enter. It also doesn't determine how to buy the bottom. That's not what this tool does. It prepares you to enter a stock based on information that it provides you. And the information is that it's getting weaker and weaker on its way down. So you got to combine this with other indicators, whether it's breaking the trend, or let's say we've got a little wedge formation here. Maybe when it breaks out of the wedge, you might consider this a good buying opportunity because it broke out and it failed to create a new low. And you can see that the MACD is converging, or diverging rather. And based on that, you might get an entry point. If we look at another stock, this is SPT on the daily chart, we can see the same thing. We can just, let me stretch this out. We can see that a higher low is being made on 2 occasions, whilst the price is creating a lower low. Now, it's up to you to decide what the technical analysis tool is that you combine with the negative divergence, or in this case a strong positive divergence. It's up to you to determine at what point you consider buying based on other trend lines, based on perhaps a horizontal breakout or a higher low being made. It's totally up to you, but at least this information here with the divergence tells you that the likelihood of buying, or a shift in momentum from bearish to bullish, is just more and more likely every time that this divergence occurs. Now, of course, it's not perfect because, as you know, that fundamental analysis, there could be a news release that alters the direction of the chart.